What a run it has been. 1 month ago, the public account was sitting around $3.3 million. Now it is around 3.85 million. That is not a small move. That is not a rounding error. That is the kind of movement that reminds you what happens when disciplined capital, good businesses, and time begin to work together. But I do not want you to look at that number and only feel excitement. I want you to look at it as evidence of a process. A portfolio does not become meaningful because someone gets lucky for a few weeks. A portfolio becomes meaningful because over a long stretch of time, the owner keeps doing the basic things correctly. Working hard, working smart, finding businesses with long runways, buying when the risk-reward is attractive, avoiding emotional decisions, letting winners compound when the thesis remains intact. That is the principle. If you are serious about the next 5 to 10 years, you should not be thinking only about where your portfolio is today. You should be thinking about where it can be if you lock in the right habits. Now, 5 years is a long time in markets. 10 years is an enormous amount of time. In 10 years, a good business can double, triple, or become something the market still does not fully understand today. A small company can become a category leader. A discounted growth stock can recover as earnings catch up. A brand can move from niche to mainstream. A platform can become part of daily life for millions more people. But that does not happen by accident. It happens when you identify the right growth, pay a reasonable price for it, and then stay patient enough to let the numbers prove the story. That is why I am focused now on 4 stocks I am buying in May 2026. All 4 are growth stocks. All 4 have very strong long-term growth potential. All 4, in my opinion, are trading at attractive valuations relative to what they can become over the next several years. But I want to be clear from the beginning. Attractive valuation does not mean risk. Free growth does not mean guaranteed. A big opportunity does not mean the next $10 in the stock price will be up instead of down. The question is not, where will the stock be next week? The question is, what can this business become over the next 3, 5, 7, or 10 years? And am I being paid enough for the risk I am taking today? That is how I think the first company is SoFi Technologies. SoFi is around a $16 stock in the source framework. In the public account, the position is already up around 95%. Shares were first bought around $6.90, with additional shares purchased up to around $11.74. That history matters, but it should not become the whole story. The mistake many investors make is that they anchor to their original price. If they bought lower, they think anything higher is expensive. If they miss the lower price, they think the opportunity is gone. That is not how serious investing works. The real question is what the company can become from here. At around $16, I still see SoFi as a major long-term opportunity. Why? Because SoFi is not merely a fintech app. It is trying to become a full financial platform for a new generation of customers banking, lending, credit cards, investing, crypto access, personal loans, financial services. The company is building an all-in-one money platform at a time when many younger consumers do not feel deep loyalty to legacy banks. That matters. The old banking model was built on branches, tellers, ATMs, paper forms, physical locations, and a large traditional cost structure. The new model can be more digital, more asset light, more integrated, and more aligned with how younger people actually manage money. SoFi is trying to become the bank for those people. That does not happen overnight. But the direction is clear. The recent earnings were extremely strong in the source framework. I would grade the income statement very highly because the major numbers show that the business is scaling. Total interest income was up 31%. Total interest expense was up only 16%. That means net interest income grew 39% year over year. For a banking-related business, net interest income is one of the most important measures to watch. It tells you whether the company is earning more from its interest-bearing assets than it is paying on its liabilities. When net interest income grows strongly, it suggests the core financial engine is working. Loan origination, sales, securitizations, and servicing were up 169%. Loan platform fees were up 44%. Total non-interest income was up 49%. Total net revenue was up 43%. These are powerful growth numbers. There were some weak spots. The technology products and solutions category was down 43% in the source. Sales and marketing expenses were up 41%. Income tax expense jumped 279%. But despite those costs, net income grew 135% year over year. Diluted EPS doubled. That is the kind of operating performance that matters. The company is not simply growing members while losing control of the financial model. It is increasingly showing that growth can translate into profitability. That is what the market needs to see. Now, the member growth is one of the most important parts of the SoFi story. Back in 2022, the company had about 5.2 million members. By the end of last year, it had around 13.6. In the first quarter, it reached roughly 14.7 million. That is not a small customer base anymore. It is beginning to reach real scale. But compared with the biggest financial institutions, it is still early. Large banks in the United States can have tens of millions of customers, sometimes 50 million, 70 million, or even over 100 million. SoFi is not there yet. But the growth path makes it possible to imagine a much larger customer base over the next 5 to 10 years. That is the opportunity. The company has roughly 10% unaided brand awareness in the source framework. That means the brand is known but not fully penetrated. There is still a long way to go. As awareness rises, member growth can continue. As members join, they can adopt more products. As they use more products, the relationship becomes stickier. As they grow wealthier over time, the value of those relationships can increase. This is how financial platforms compound. A customer who joins young for a simple checking account or loan can later need investing services, credit products, mortgages, business banking, and other financial tools. If the company keeps the customer, the lifetime value can grow. This is why banking can be a powerful business when it is run well. Attract customers, keep customers, do not blow up in recessions. That sounds simple. It is not easy, but it is the core. Anthony Noto has done a strong job so far in the source framework, but he must continue to do a strong job. Banking is dangerous when management takes too much risk. The next major recession, whenever it comes, will test SoFi. Every financial institution is judged not only by how it grows in good times, but by whether it survives bad times. That is the risk. A bank can look brilliant in expansion and fragile in contraction. SoFi must not chase reckless growth. It must not underwrite loans poorly. It must not stretch for yield. It must not allow the excitement of becoming a giant to make it forget the first rule of banking: survive. If SoFi keeps attracting members, keeps current members, and avoids catastrophic mistakes in recessions, the long-term market cap opportunity is large. Today, SoFi is around a $20 billion market cap in the source framework. JP Morgan is over $800 billion, Bank of America is over $300 billion. Morgan Stanley is near $300 billion. These comparisons are not predictions, they are scale references. They show how large successful financial institutions can become if SoFi becomes a true banking giant over the next decade. A $100 billion or several hundred billion dollar market cap is not impossible in the source's view. But again, it has to execute. The buy zones are straightforward in the source framework. Under $15 is a great buy zone, under 10 is a steal, though one should not expect the stock to necessarily return there. $15 to $20 is still a very good buy zone, 20 to 25 is still good, 25 to 30 becomes more of a maybe zone. Above 30, the source would view it more as a hold. That framework is important because price matters. The same company can be a strong buy at one price and only a hold at another. The business does not need to change for the risk-reward to change at $16. The risk-reward is still attractive in this framework. That is why SoFi is the first stock. The second company is ServiceNow. This one is very different from SoFi. ServiceNow is not a bank. It is a software company that helps large enterprises manage workflows, requests, tasks, service operations, and internal processes. In simple language, large companies often have too many systems, too many messy workflows, and too much organizational friction. ServiceNow helps organize and automate that work in one platform. This is a powerful kind of software. Once a large company installs a system like ServiceNow and integrates it into daily operations, it can become deeply embedded. Employees use it, teams use it, managers use it, departments use it, customer service, HR operations, and other workflows can depend on it. That creates switching costs. If a big corporation rips out mission-critical software, it has to spend time, money, training, and management attention to replace it. That is painful. Therefore, if the product works, customers tend to stay. This is why enterprise software can be a holy grail business model. Subscription revenue, high retention, expanding usage, strong cash flow, deep customer relationships. Once the system becomes part of daily work, it can be hard to replace. That is why ServiceNow has long been a strong business, but the stock has been crushed. In the source framework, it is down about 52% over the past year, trading around $91. Why? Not because the core business is suddenly bad. The market is worried about several things at once. First, artificial intelligence creates uncertainty. Investors do not fully know how AI will affect companies like ServiceNow, Salesforce, and other enterprise software platforms. Some fear AI will disrupt the seat-based software model. Some fear customers will need fewer licenses. Some fear new AI native products will replace legacy software systems. Some fear margins will be pressured as companies spend heavily to integrate AI. Those fears are real enough to pressure valuation, but they may also be overdone in the source framework. AI is viewed more as an opportunity for ServiceNow than a threat. Why? Because ServiceNow already sits inside large enterprises. It already hosts and organizes important data and workflows. AI needs data. AI needs workflow context. AI needs enterprise adoption. ServiceNow can integrate AI into existing systems and help customers automate more work. If that happens, AI strengthens the platform rather than destroys it. But the market does not know that yet. Second, ServiceNow is in an awkward profit phase. The company recently completed several acquisitions. Acquisitions bring integration costs, AI investments add costs, expenses rise. This creates a period where revenue growth remains strong, but earnings growth looks weak. In the source framework, revenue is growing 22% while diluted EPS is up only around 2%. That looks ugly if you only look at EPS growth. But if the cost pressure is temporary, the opportunity is that earnings growth can re-accelerate later after integration and AI investments stabilize. This is why the stock may be cheap. The market is looking at the awkward near-term earnings phase. A long-term investor is looking 3, 5, or 7 years out. That difference creates opportunity. ServiceNow's financial trends remain strong in the source framework. Revenue has grown for years. More companies buy the software. Existing customers spend more. The company generates profit and strong cash flow. Operating cash flow, free cash flow, purse hair, and operating income all show the kind of pattern one wants to see in a high-quality software company. The historical PE has collapsed. That does not automatically make the stock cheap. A stock can deserve a lower multiple if the business is truly being disrupted. But if the business remains strong and the profit compression is temporary, then a lower multiple can create a very attractive long-term setup. That is the thesis. The bull case assumes revenue growth around 20% on average from 2027 to 2030 and net income growth around 25%. For a high-quality SaaS company with those kinds of growth rates, a 40 to 60 PE might be fair in the source framework. That would put the stock somewhere around the mid 300s to low 500s over the next 4 to 5 years, creating a very high compound annual growth rate. The base case is more conservative. It assumes revenue growth around 17% on average through 2030, slower than the current 22%. It assumes net income growth around 22%. A 30 to 35 PE would be fair under those assumptions. That puts the stock around 237 to 270. $7 implying roughly 30% annualized return from the source purchase area. That is why the stock is being bought, not because the next $10 are clear. The next $10 could be lower. The stock could go to 81 or 101. No one knows. But if the stock can return to 200 plus or higher over the next few years, the current price can be attractive. Even the bear case in the source framework assumes only 12% revenue growth and 12% net income growth with a 25 to 30 PE. Under that bearish scenario, the stock could still produce a double-digit compound annual return and potentially outperform the S&P 500. That is a strong risk-reward setup. The only way the investor does not make money in the stock over the coming years in this framework is if the low-probability disruption case plays out and the business model is truly broken by AI or competition. That risk exists. It cannot be ignored. That is why the position cannot become over-leveraged or oversized. But the probability is viewed as low. So ServiceNow is a buy. The third company is E.L.F. Beauty. This is one of the most interesting consumer growth stories because it combines affordability, brand power, repeat purchasing, and optionality through acquired brands. The stock is around $61 in the source framework. In the public account, the position is up around 749%, with first purchases going back to February 2019 around $7.28. That is a huge win. But again, the question is not what the stock already did. The question is what it can still do. E.L.F.'s core brand is built around affordable, high-quality cosmetics. This is an important combination. In beauty, price matters, but product quality and brand identity matter too. E.L.F. has been able to create a brand that consumers see as both inexpensive and good. Many products are under $10, and most are under $20 in the source framework. That matters in a consumer environment where people still want beauty products but may be sensitive to price. A company that offers strong value can take share. It can appeal to younger consumers. It can expand across retailers such as Walmart, Target, and many other stores. It can become a habitual purchase. Beauty also has a powerful consumption-based business model. People do not buy makeup once and then disappear. They run out of concealer, lip gloss, skincare, body wash, and other products. They come back. They buy again. If the brand earns trust, the repeat behavior can be very valuable. This is why the source compares it to a SaaS-like model in consumer products. It is not software, but it has recurring consumption that matters. E.L.F. also owns other brands. Naturium is growing in skincare and body care, including body washes and lotions. It has become more visible in major retailers, but the most exciting short-term opportunity is Rhode, the brand created by Hailey Bieber, wife of Justin Bieber. In the source framework, Rhode is one of the hottest brands, if not the hottest brand, in the beauty and makeup space. It has enormous short-term expansion potential over the next 1 to 2 years. Why? More retailers, more products, more distribution points, more inventory, more category expansion, more ability to satisfy demand when products sell out. This is a classic consumer brand scaling opportunity. A hot brand can grow extremely fast when distribution expands. The danger is that hot brands can fade, trends can change, celebrity-linked brands can lose momentum. Execution matters. But if E.L.F. can scale Rhode properly, the short-term growth contribution could be enormous. The stock trades around 18 times forward earnings in the source framework for a company expected to generate double-digit revenue growth and strong double-digit earnings growth for years. That appears too cheap. That is the thesis. The bull case for E.L.F. is one of the most exciting among the source S holdings. It assumes revenue growth of 25% in 2027 and 20% after that, with net income growth around 30% on average from 2027 through 2030, for a consumption-based business growing top line 20% and bottom line 30%. A 35 to 40 PE may be fair. Under that scenario, the stock could move into the 330 to 380 range by 2030, creating a very high compound annual growth rate. The source views this as a lower probability bull case, perhaps around 10%. But the upside is enormous. The base case is still very attractive. It assumes 23% revenue growth in 2027. 20% net income growth in 2027, and then 15% revenue growth and 20% net income growth after that. Those assumptions are not viewed as aggressive in the source framework. A 30 to 35 P would be fair. That puts the stock around $206 to $241, implying a 35 to 40% compound annual growth rate. That is extremely attractive. Even the bear case is strong. It assumes 18% revenue growth in 2027, then only 9% revenue growth after that, and only 9% net income growth for E.L.F. That would be a disappointing growth path, yet with a 23 to 28 PE, the stock could still generate around 15 to 21% annualized return. That is why the stock is viewed as so compelling. When the bear case still looks like it can beat the market, the risk-reward is powerful. The source S buy rule is simple. Anything under $100 is a buy. That is a strong statement, but it comes from the projected upside across the base and bear cases. At $61, the stock is far below that threshold. The risk is that the projections are wrong. Maybe growth slows faster than expected. Maybe Rhode does not scale as well. Maybe beauty spending weakens. Maybe competition intensifies. Maybe margins compress. Maybe acquisition integration is harder. Maybe the market assigns a lower multiple. Those risks exist. But in the source framework, the current valuation more than compensates for them. That is why E.L.F. is one of the most attractive stocks in the market right now in the source S view. The fourth company is Celsius Holdings. Celsius is another consumer growth story, but in beverages rather than beauty. The company owns Celsius, the energy drink brand that has become very popular over the past 5 or 6 years. It also owns Alani, and it recently acquired Rockstar from Pepsi in the source framework. It also has a major distribution relationship with Pepsi. That distribution relationship matters enormously. In beverages, distribution is power. A brand can be loved by consumers, but if it is not on shelves, in convenience stores, in grocery chains, in gyms, in gas stations, and across international markets, growth is limited. Pepsi distribution can help Celsius reach more places faster. This is why beverage stocks can become extraordinary long-term compounders. Coca-Cola, Pepsi, Monster. These are some of the great consumer business models in market history. They sell products that people buy repeatedly. They have brand power. They have distribution scale. They can expand internationally. They can improve margins. They can generate strong cash flow over time. but the biggest money is made when you get in early enough. Today, Coca-Cola and Pepsi can still be good stocks. They can pay dividends, they can compound slowly, but the life-changing returns were made when those companies were much smaller and had much more runway. Monster created enormous returns for early investors because the brand grew from a smaller base into a global energy drink powerhouse. Celsius in the source framework is still early. It has already had a strong run over the past 5 or 6 years, but its market cap is still under $10 billion, around $8.6 billion. Monster is around $73 billion. Coca-Cola and Pepsi are hundreds of billions. That does not mean Celsius will become them, but it shows the runway if the brand becomes a global beverage platform. The next decade is about international growth. Celsius and Alani are well distributed in the United States with still more room to expand. But international revenue is still a small portion of the company that creates a long runway. The Pepsi relationship strengthens that opportunity. Pepsi bet big on Celsius in the same way Coca-Cola bet on Monster distribution, and corporate partnership can accelerate scale. The stock is around $33 in the source framework. Wall Street is beginning to come around to the story. JP Morgan maintained an overweight rating with a price target around $67 even after cutting the target. Citigroup cut its target to around $60. Those targets imply major upside over 12 months. But the short-term target is not the whole point. The real opportunity is the next 10 years. The source bull case for Celsius assumes about $6.8 billion of revenue by 2030 and about $1 billion of net income. That assumes around 15% top-line growth and 25% bottom-line growth with a 35 to 40 PE. The stock could generate a compound annual return in the 43 to 48% range. That is a huge bull case. The base case assumes around $5.9 billion of revenue by 2030 and $743 million of net income. It assumes 10% revenue growth and 15% bottom-line growth for a recurring consumption-based business where customers drink the product again and again. A 28 to 33 PE may be fair. That produces a 25 to 30% compound annual return. That is very attractive. The bear case assumes about $5.1 billion of revenue by 2030 and $516 million of net income, with only 5% revenue growth and 5% net income growth per year. That would be a disappointing outcome relative to the opportunity. Even then, with a 20 to 25 PE, the stock could still generate around 5 to 11% annualized return. That means the bear case may still make money, while the base and bull cases are extremely attractive. This is the type of asymmetry the source is looking for. Celsius has several operating levers. Revenue can keep growing through more distribution, higher sell through more brands, more products, and international expansion. Gross margins can improve over time. Net margins have a long runway. Free cash flow can grow substantially. Earnings per share can trend higher. But there are risks. Beverage competition is fierce. Energy drinks are crowded. Consumer tastes can change. Distribution can create dependence on partners. Integration of Alani and Rockstar must be managed well. Growth expectations can become too high. Margins can disappoint. The stock can remain volatile. But the long-term runway is compelling. That is why Celsius is a buy in the source framework. Now, stepping back, these 4 stocks are different. SoFi is a fintech banking platform trying to become a financial giant for younger generations. ServiceNow is an enterprise software platform facing AI fears and temporary profit pressure despite a strong subscription model. E.L.F. Beauty is a consumer beauty compounder trading at what the source sees as a very cheap multiple relative to growth, with Rhode and Naturium adding optionality. Celsius is an energy drink and beverage platform with Pepsi distribution, Alani and Rockstar assets, and a major international runway. Different industries, different business models, different risks, but the same investing logic connects them: high growth, attractive valuation, large long-term runway, clear operating catalysts, a price that creates strong upside if the base case plays out. That is the framework. I want to emphasize something important. The next $10 in any of these stocks does not matter very much to a long-term investor. SoFi could pull back. ServiceNow could stay awkward for months. E.L.F. could trade down before it trades up. Celsius could be volatile. Markets can be irrational. Interest rates can move. Recession fears can appear. AI narratives can swing. Consumer spending can weaken. Analyst targets can change. Short-term price movement is mostly noise if the long-term thesis remains intact. But that does not mean price is irrelevant. Price matters at purchase. If a business is worth much more than the market is charging, you buy. If the stock runs far ahead of the business, you become more careful. If the thesis breaks, you reassess. The goal is not to predict every short-term move. The goal is to buy enough long-term value at a good enough price and then let the business do the work. That is why the next 5 to 10 years matter. This is not a one-week trade. This is a portfolio-building mindset. Now, the source repeatedly returns to the idea of working hard and working smart. That may sound motivational, but there is a financial truth inside it. Your portfolio compounds, but your behavior determines the fuel. If you continue earning, saving, investing, studying, and improving, the next 5 to 10 years can change your life. The stocks matter, but the system matters more. A great stock pick with bad behavior can still fail. A good portfolio with consistent contributions can become powerful. A person who keeps learning can see better opportunities. A person who controls emotion can hold through volatility. A person who buys growth at good prices can create wealth over time. That is the machine. Now, let us look at the risks across the four. SoFi's risk is financial cycle risk. Banking is simple until it is not. A recession can reveal credit problems if SoFi grows too aggressively or takes on bad loans. The market will punish it. It must manage credit, liquidity, customer retention, and regulatory pressure. ServiceNow's risk is AI disruption and growth deceleration. If AI truly reduces the value of its platform, the market is right to be afraid. If expenses remain elevated and profit growth does not recover, the valuation may stay compressed. E.L.F's risk is consumer brand risk. A hot brand can cool, competitors can copy. Retail execution can disappoint. Rhode can fail to scale. Beauty spending can weaken. Celsius's risk is category and distribution risk. Energy drinks can be competitive. International expansion may take longer. Pepsi distribution must translate into real sales. Margins must improve as expected. None of these risks should be ignored. But investing is not about avoiding all risk. It is about taking risks where the reward is sufficient and the thesis is strong in the source framework. The reward is sufficient. Now, I want to put the four stocks into a portfolio perspective. These are all growth stocks. They are not defensive utilities. They are not treasury bills. They are not low volatility dividend holdings. They can move sharply. They can fall 30, 40, or 50% during market stress. They should be sized appropriately. A portfolio of only aggressive growth stocks can be extremely volatile. If you own them, you must understand why. You must know your time horizon. You must know how much volatility you can tolerate. You must know whether you are investing or trading. You must know what would make you sell. The source is bullish, but it does not mean anyone should be reckless. Conviction does not replace risk management. Now, let us return to SoFi and think about the long-term structure. SoFi's biggest opportunity is that it can become a digital financial relationship platform. If it continues adding members and products, it can deepen engagement. Banking is a trust business. Once customers use a financial institution for multiple services, switching becomes less likely. The company can earn through net interest income, loan sales, platform fees, and non-interest income. The key is customer lifetime value. If SoFi can acquire customers cheaply enough and monetize them over many years without taking excessive risk, the business can compound. The danger is the same as every financial institution. When money is easy, growth looks good. When money tightens, credit quality matters. The next recession will be the test. If SoFi survives that test and keeps growing, the market may begin treating it less like a speculative fintech and more like a future banking giant. That multiple re-rating could matter. Now, ServiceNow's key is that enterprise software may be more durable than the market fears. AI may not replace the platform. AI may make the platform more valuable if companies use ServiceNow as a workflow operating system and AI gets embedded into those workflows. ServiceNow could remain central. The awkward phase is temporary if the company turns revenue growth back into profit growth. The market hates uncertainty, but uncertainty can create mispricing. If the company continues posting strong revenue growth and eventually shows expanding earnings again, the stock can recover substantially. This is the kind of setup long-term investors should study: a strong business, a temporary narrative problem, a compressed valuation. That can create opportunity. Now, E.L.F's key is brand momentum plus price value. In consumer categories, some brands win because they are premium. Others win because they are cheap. E.L.F is interesting because it combines affordability with perceived quality and social relevance. That can be very powerful in beauty. Rhode adds a different kind of opportunity. It is more celebrity-driven, more viral, and potentially faster. Growing in the near term, Naturium adds skincare and body care expansion together. The company has multiple growth engines. If E.L.F. can manage these brands without diluting identity, overpaying for acquisitions, or losing margin discipline, the growth path can remain strong. At 18 times forward earnings, the market may not be pricing that properly. That is the opportunity. Now, Celsius's key is distribution and habit. Energy drinks are habitual products. People who like a brand often drink it repeatedly. If Celsius and Alani gain shelf space domestically and internationally, revenue can scale. Rockstar adds another asset. Pepsi distribution can accelerate the process. The beverage business can be wonderful when the brand works. It can generate high repeat purchase, strong cash flow, and long international runway. But it requires execution. Distribution alone is not enough if sell-through is weak. A brand must keep consumer attention. A product must keep taste and identity. Margins must scale. If Celsius executes, it could become one of the next great beverage growth stories. That is why the stock is still early in the source framework. Now, the deeper portfolio lesson is that you do not need dozens of ideas to build wealth. Sometimes a few strong ideas, purchased at good prices and held with discipline, can do much more than a scattered portfolio of mediocre positions. But concentration only works if you understand the businesses and risks. If you do not understand them, concentration becomes gambling. A focused growth portfolio requires more work. You must follow earnings. You must track revenue, you must track margins, you must watch management, you must monitor valuation, you must know when the thesis changes. That is why working smart matters. You cannot simply buy 4 names and stop thinking. You buy them because the current evidence supports the thesis, and then you keep checking whether the evidence improves or deteriorates. Now, I want to address valuation one more time. The market often overreacts to uncertainty. ServiceNow is punished because of AI fears and near-term profit pressure. E.L.F. is cheap because the market may not trust the durability of growth. Celsius has been sold off despite long-term distribution upside. SoFi may still be underappreciated because the market has not fully accepted it as a future banking giant. These are the kinds of mispricings that growth investors look for. Not low PE alone, low price relative to future growth. A cheap stock with no growth is not the same as a cheap growth stock. The key is growth durability. If the growth is durable and the valuation is low, the upside can be large. If the growth is temporary, the valuation may be a trap. So every thesis comes down to whether the growth lasts. For SoFi, member and revenue growth must last. For ServiceNow, subscription and enterprise adoption growth must last. For E.L.F., brand and retail growth must last. For Celsius, beverage distribution and category growth must last. That is what to watch. Now, the projections in the source are not promises. They are scenarios, bull case, base case, bear case. That is a good way to think because the future is uncertain. No investor knows exactly what revenue, earnings, or multiples will be in 2030. But scenario analysis helps. The bull case tells you what happens if execution is strong. The base case tells you what the investor actually expects. The bear case tells you what might happen if growth slows. The goal is to buy when even the bear case is acceptable and the base case is very attractive. That is the ideal setup. E.L.F. and Celsius, in the source framework, have unusually attractive bear cases. ServiceNow's bear case still looks like it can outperform. SoFi's long-term asymmetry comes from the possibility of becoming a much larger financial institution. That is why the 4 are being bought. Now, there is a behavioral lesson here too. People often want certainty before buying, but if the uncertainty disappears, the price often disappears too. By the time everyone agrees that ServiceNow will not be disrupted by AI, the stock may be much higher. By the time everyone agrees E.L.F. can scale Rhode and keep growing, the stock may be much higher. By the time everyone agrees Celsius is a global beverage winner, the stock may be much higher. By the time everyone agrees SoFi is a real banking giant, the stock may be much higher. The investor gets paid for taking uncertainty when the odds are favorable, not for waiting until the story is obvious. But uncertainty must be analyzed, not ignored. That is the balance. Now, I want to close with the 5 to 10-year mindset. Imagine where your life can be if you keep working hard and working smart over the next decade. Imagine where your portfolio can be if you keep finding businesses like these when the market gives you attractive prices. Imagine what happens if you combine personal income growth with disciplined investing. Imagine what happens if you avoid panic, avoid overleverage, and keep your focus on long-term business value. That is how wealth is built. Not in one day, not in one stock, not in one video, through repeated intelligent decisions. SoFi, ServiceNow, E.L.F. Beauty, and Celsius are not the same type of company, but each represents a business that could be much larger several years from now. SoFi could become a major digital banking institution. ServiceNow could remain one of the most important enterprise workflow platforms and turn AI into an advantage rather than a threat. E.L.F. could continue compounding through affordable beauty, Rhode, Naturium, and repeat consumer demand. Celsius could become a much larger global beverage company with Pepsi distribution. Alani, Rockstar, and international expansion, that is the opportunity. The market may not reward them immediately. The next move may be lower. There will be volatility. There will be fear. There will be earnings reports that confuse people. There will be analyst downgrades. There will be macro noise. But if the businesses execute, the next several years can matter far more than the next several weeks. That is the point. Investing is not about predicting tomorrow. It is about buying future value at today's price when the odds are in your favor, and in these 4 stocks, the source framework sees exactly that: high growth, attractive valuation, real businesses, long runways, clear risks, and enough upside to justify stepping in. Now that is the process, that is the discipline. And that is why these 4 stocks are being bought in May 2026.